Welcome, everyone, to the offices of Gresham House. I'm delighted to be here for Markets Happy Hour podcast. We are going to do our usual market update that we do every week, and this is about our usual 5 topics, but this is going to have a bit of a deep dive on nature finance as it relates to portfolios and overall asset allocation drivers, etc. So I'm delighted to be joined here by Tony Dalwood on my left and Derek Heffernan on my right, and we have Joe O'Carroll from Gresham House at the back, off camera. And the way we'll set this up is about a 35-minute conversation. Given we're in front of a live audience, we'd love to have your questions, your insights. I will be drawing upon the Gresham House participants here for a lot of those insights. And I'll have the slides at the back to refer to in terms of just some of the topics, and we'll kick off. So this is something we talk about, the 5 fingers of the hand every week: inflation, interest rates, equity markets, geopolitics, and other asset classes. Clearly, this podcast will have a greater than usual focus on other asset classes. And we are going to be talking through always what these macro factors mean for a portfolio and how we should think about them. When I'm on site like this in Dublin, in the Eurozone, it's nice to ask a little bit about your impression from the ground. We have some allocators in the room, get a bit of a vibe check in terms of what you're feeling in terms of the inflation, interest rate, the consumer sentiment. And that's something always that we like to reflect when we do this on the road. So some of the subtopics here, clearly inflation can't hide any longer. We know that it's creeping upwards. We're going to talk a bit about that. The jobs maybe have had a bit of a rethink. Are they all being replaced by AI? Is there a job market that's actually booming? And what does that mean for interest rates later, obviously? The arms race in terms of AI has now turned into a capital race, as we have 3 pretty high profile IPOs coming to market, as well as other existing tech companies raising. And then when it comes to nature, I've used the pun of our second nature, but we asked about nature finance. What's happening in the field of nature finance, and how is that relating to some of these other factors I've just mentioned? So we'll kick off with that. So on the first side, inflation is clearly heading in the wrong direction. We had a 4.2% number out of the US today. We know that here in Europe, it's heading close to 3%. Some of that is driven by the energy race, obviously the Strait of Hormuz and geopolitics. But for those who thought the consumer was about to catch a break in the form of either reduced interest rates or just reduced pressure on pricing, clearly we're heading in the wrong direction. And I love this picture of Christine Lagarde, because it's a little bit difficult to discern necessarily what we're actually reading out of the numbers. But it does seem at this point that the next move on rates is upwards from the ECB. I'd love to maybe ask Derek, what's your take here in the Eurozone on inflation? What's next? And is the consumer well poised to survive this?
We are incredibly biased on this topic. We've been inflationists for the last 5 years. We believe that the inflation genie is out of the bottle and it's not going back anytime soon. And any kind of little trends down will just be blips down. And we believe that 3% is the new 2%. I think if you can look over the last 5 years, central banks have missed their targets pretty much every quarter for 5 years running. And somehow we just we look at market participants to still believe their inflation targets and just scratch our heads. So we think that OECD bonds, which were a cornerstone of portfolios, do not serve the same purpose in an inflationary environment. And this is it's a very difficult environment for bond investors. Thank God we're mainly equities here and we don't have to worry about that problem. But we do think it creates this inflation that we believe is going to be persistent. It's going to be here for the next generation. We think that's it's the major issue facing investment markets.
And before I go to the vibe check in the room, I just pass to Tony. What does this mean for nature? We always think of real assets as inflation hedge, inflation resilience. Does this participate in inflation in that way?
In summary, yes. If you look at the core of nature finance, it tends to be around forestry and land. If you look at the correlation with inflation, it's very high, 0.5 to 0.7, depending on which period you look at. So this is a period now we're entering where people for the last 30 or 40 years have ignored, because they've taken for granted a low inflation environment. The question then is this structural? Is this cyclical? And if you look, we had some bouts over the last 5-10 years where there has been temporary spikes in inflation, but it's been temporary, whether it be because of COVID, whether it's been through energy or war. But there is a lot of evidence that this is a bit more structural this time. Wage price, the power of labor within the economy is increased over the last 10 years or so. And you can see that with trade union bargaining across particularly Western Europe. And that's leading to, I think, structural inflation. Now, There's evidence as a result of things like AI and unemployment rising that perhaps that will then start subsiding. So the natural market mechanisms will kick in and mean that inflation doesn't go off into what we had, the hyperinflation in the 70s. However, there is real significance to start asset allocators of now. I've been traveling the world quite a lot in the last 6 months, from Canada, North America through to Asia, Australia. And it's very clear that allocators for the first time in quite a long time are beginning to recognize this is something they have to consider, particularly for long duration investment liability matching. And that is something that we therefore start positioning, particularly around nature finance. So forestry has a huge, as I mentioned, inflation correlation, but also likes of agricultural farmland in Ireland. Of course, we have a lot of experience of farmland and agriculture, and that's at the core. There's also other aspects in nature finance, which we can touch on a bit later, things like carbon credits, biodiversity, but those tend to capture probably most of anything when people talk about nature investments. Because importantly, my final point, the last 3 years, the focus on financial returns has returned. We had a period of time, sustainability was the theme. Sustainability without, let's talk about how much money we make for clients and investors, was secondary. Now, quite rightly, financial returns has come back, and the fiduciary responsibilities of allocators and how they make financial returns is at the primary focus.
Yeah. And let's just, that's a great point, I think, in terms of the vibe check. So we're sitting here, you mentioned the consumer just having to live with more inflation. We all know the consumer's inflation is usually higher than the headline inflation, the actual expressed inflation. This chart does suggest that despite Labour having had some power in the past, it has not kept pace. So the consumer is earning less now in real terms. And equally, the Main Street, Wall Street divide with the price of oil and the gas, etc., and equally just the interest rates, if that now is also a pressure. How's Main Street surviving? And I'd love to use some people from the room as well to chip in.
Yeah, just from our view of the corporate side, it's definitely that K-shaped economy. We actually touched on it the last time you were in town.
In November.
Yeah, it's kind of just before it kind of really got prominence in the media. But the top decile, especially in the US, are flying it. They're absolutely doing fine. Their equities go up in value every day. Their spending power goes up. They're immune from the real world, and it's the bottom 80% that are really struggling. Gas prices are going up. Your health insurance costs is going up. Nothing's coming down. Everything is a struggle. And when we do our kind of bottom up work on the Dollar Generals of this world, the McDonald's, the Wendy's, we can see it in their numbers that they were telling us this is a problem in Q1 last year, and it's really translating now into real world. So we do think it is a big issue. And yeah, I won't go off on too much of a rant. But we do think the equity market is holding up a lot of the spending in the US, and if that domino falls, we think there could be issues.
Well, it's a good segue, unless anybody from the floor has anything to contribute on the sense of inflation here. I think it's a good segue into where we are in terms of the equity market and that K-shaped economy. So we know this is just Japan, but Japan looks like it's going to be the latest central bank to raise rates. The ECB could just be around the corner. In terms of the jobs narrative, I think this is quite important. We've had this AI is going to kill half of white collar jobs narrative that was instantly flipped on its head, as there was a sense that there was perhaps that wasn't a good PR strategy for these firms trying to go public. There was also a sense that maybe it was misplaced or there wasn't the translation effect of AI yet, but and then there was even furthermore a sense that that maybe this jobs narrative was all a conspiracy theory to actually reduce the power of labor. If people thought they had no power on that side, that they would not try to bargain any longer. So it seems that there is now a narrative that AI will not kill jobs. I think that is actually misstating a real sense of anxiety that is circulating around AI, a real sense of angst. I had a podcast regarding AI just on Monday, and there was a real sense that people cannot think straight at the moment because they cannot plan.
Yeah, I think I listened to your podcast and it reflected actually with something on RTE News that night as well. They were interviewing students coming out of the exam hall in the RDS, and you could actually tell this was it was like when they did interviews on the housing market a couple of years ago. That was the main concern, and it is a real issue. I think Tony touched on an interesting point on demographics, and you mentioned Japan. We can obviously, Japan is almost 10 years before everyone else in terms of demographics, and we can actually see Labour is getting some power back in Japan. And I know the AI kind of story might be 18 months or 12 months down the road, but at the moment we are actually seeing workers especially in their mid-career, have some bargaining power. And look, we think that feeds back into this inflation agenda. Whether AI breaks that or not, we'll have to see. I think probably I'm more on the skeptical camp. On that now, I know the chair of the Federal Reserve, who's a lot smarter than me, is on the optimistic camp. He's personally invested, I think, in 20 AI startups, and he thinks this is a massive disinflationary boom. But yeah, we'll have to wait to see.
Yeah. Well, I think it's an important point. We're here to partly talk about nature finance, but let's look at where where all the attention is and where all the momentum is. It's not on nature right now. For the most part, it's on AI, it's on technology. The next slide is around the race to raise capital. It's hard to pick up a newspaper today with that hearing about SpaceX and going pricing on Friday it is, right? And the number of bids that have come in, and they're, I think, 4 times oversubscribed. And we know that the valuation story there doesn't necessarily hang together. And I suppose I'd love to hear from you if you can have a sense of what's actually going on. Why is this 4 times oversubscribed?
I'll let the man who does it daily, but I've got some views.
I don't think my views are allowed to be aired. I honestly think this is going to be horrific for the mom and pop investors. I think the fact that they were included in some indexes is an indictment on our industry. A lot of passive money is going to be buying shares in these companies at 100 times sales. Very difficult to see how they make any return on that. So we won't be partaking. Gresham House won't be partaking in any of the upcoming IPOs. That's the summary.
Say no more.
Say no more. Yeah.
Well, I think before moving to Tony, I think what's interesting is in real assets, by definition, real actual trees, you get a huge amount of scrutiny as to your plans, as to the projections, as to the outcome of this of your investments. Here we have something that is almost the opposite of real. Space centers in space, Mars, rockets that have not yet been created, AI demand that has not yet been proven, and yet we have, I would say, is there any scrutiny?
We've been here before, haven't we?
Some of us have.
Some of us have. If you look back in history, these things come and go. Industrialization, TNT, the invention of the computer, the whole world's going to know jobs going to be needed for anybody. The computer does it. We evolve. The free market allows us to evolve. New jobs created. We evolve as societies and economies, and it's been proven. The TMT boom came and went, and we didn't just stay at home. We went back to work, and it just facilitated the new world. And a good example of that, and I think to Derek's point, is if you look at some of the things you invested in 1999, Vodafone, when it hit just under £4, you are 26 years later, and what's the price of Vodafone, Derek?
It's not £4.
No, it's about £1, I think. So you've got a situation 26 years later, you've lost 75%, and in real terms, you can make that whatever number you want. That's a real example. And at that stage, people had to own Vodafone. It was it was going into the index, became 12% of the UK market. Consultants were writing to clients saying you really need to tell your fund managers because it's a risk not having 12% of the index. And I was part of a company, Phillips and Drew, that had 0 in it. And we were told that we had to own it because it was a high risk not to own something on a price earnings ratio of 70. And look, here we are 26 years later. Now, we were under a lot of pressure then. That is the price. That's what's going on here. People, a lot of fund managers, under a lot of pressure. Derek's under a lot of pressure to own this. And that then causes, but then in the long-term game, back to the long-term endowments, long-term insurance investors, these people need to recognize you're there for a long-term. And the absolute risk to capital, rather than the benchmark risk, needs to be recognized. Then you move into your real assets. These things have a long track record through all cycles. Trees still grow whether SpaceX comes and goes or not. Land is still usable for agriculture, whether Anthropic is there or not. It's going to be there for the next how many years. And there is evidence that it is inflation linked. And it is evidence that you are not buying at 70 PEs or 70 times sales. It's really important that you value things correctly. You have a long duration of investment horizon. And then you have a decent fund manager like Derek.
Well, I think this is the point. There is this AI arms race, but equally now a race to the capital markets, which I think is the other factor that's become quite distracting. And whether we have not only the Anthropics and OpenAI coming, but the Facebook and Google and others for additional launches, additional such issues, because why not? Why not try to raise 80 billion when everybody else is? I suppose the question is I see some allocation away from, say, Bitcoin, into something like this, which I think tells you where the risk that was in the kind of the gambling bucket, and it's now being going into another gambling bucket. It's not necessarily coming from fixed income bonds into this. But I think there is there enough demand? We have 8.3 trillion in money market funds. I have this slide here. And we've got lots of $1 trillion stocks out there. There's plenty of money to move into this.
You touched on a really good point there. The Bitcoin evangelists have become AI evangelists, and that is where the money is flowing from. Look at the negative correlation of Bitcoin with these things. It is fascinating, and you see on people who had jobs as a blockchain or Bitcoin specialists 2 years ago are suddenly AI and artificial intelligence specialists. So I think that's where the fast money is coming from, and I think Tony touched on an interesting point. A lot of this industry is benchmark focused, and if something goes in at 2% of a benchmark, you're probably your maximum risk position you can take as being 1%, let's say, but you're still buying 1% of a company that is at 100 times sales. So we do think that's there will be some institutional money, there will be some retail money, but yeah, I think it might be painful for a while, but I think the sensible money will stay out of this and continue to just continue to work away on their own companies, work away on stuff that makes long-term sense, that produces cash, that has limited capex, that gives cash back to shareholders, and ignore the noise. But yeah, it is interesting that you brought up that Bitcoin AI analogy.
I agree. You come back to cash. You come back to cash and margin of safety. When you buy something on a PE of 10, then you have a huge margin of safety that's generating cash. And you look back in time, and particularly if you're contrarian, there are things which are not in vogue, and they are the things that you should look at hard and analyze, and then put away for the long-term investor. Things that, if you go back to the early 2000s, you had in 99, 2000, you had the drinks companies, cigarette companies, industrials, the metal bashers that they used to be called. Those are the things that nobody wanted to own. They wanted the Vodafones and the tech, media and telecoms companies at the time. Those things are now materially up from that period of time. I mean, I think you're probably of the order of 15 times. If you put money into Imperial Tobacco, you're at 15 to 20 times your money from 2000, 2001. Now that's pretty good, right? And it's real money. And that was only because if you go back to those times, there was a dividend yield covered twice by cash in things like Imperial BAT that was at about 9 to 10% dividend yields.
So I think we're in this emotional time, I think, in terms of the markets, the momentum. There's an emotion attached to Elon Musk because a lot of the SpaceX valuation is his promise, his hope, his so-called magic, his personality. And I think that is clearly a divisive personality there, but it seems to be driving that. And of course, the other thing, just before we move on to some specific nature slides, is just on this AI populism. I think there is now an anti-AI populism that is emerging. The Pope didn't kick it off, but he certainly participated in good measure. And with the data center pushback, and I think a concern that there's, perhaps we talked about college graduates being interviewed and their views on AI. I get the sense that this is a fairly bipartisan issue in the US, that actually there aren't many issues that are bipartisan, but a concern around AI is actually unifying. The concern there is that if they do regulate, they will fall behind China. We talked about that in November. That was still a concern then. It seems Europe is more prone to more regulation. Do you sense here in Ireland a sense of AI, an anti-AI populism, an anti-data center populism? Or are you all on the tech bandwagon?
It's definitely anti-data center. It's news just about every week. So it's the data center predominantly because of the energy infrastructure and the demands it places on the grid. And the real problem is we haven't invested in developing the grid. And then along comes this kind of boom in data centers that are big energy demand centers. But that's causing a lot of grief. It's driving up the use of system charges, which every electricity consumer has to pay. So data centers are right in the crosshairs of public opinion when it comes to that. I would argue probably wrongly. The real issue here is that we just didn't invest enough in developing the grid. That has held back our renewables development. It has absolutely held back our offshore renewable development. So we are way behind where we should be. And then lo and behold, the consequence of that is, something happens, geopolitically a long way from here, disrupts the flow of oil and gas into the country, electricity prices and fuel prices skyrocket here, and people take to the streets protesting over that. So it is there is a kind of a circle here around it. And if from an Ireland point of view, if we don't bite the bullet, invest in the grid and invest in our renewable capacity, we're going to be forever, exposed to these geopolitical issues. There is a bit of a pushback in terms of AI usage, and again, that tends to be mostly from young people, graduates, kind of seeing graduate or entry-level jobs, not there to the same degree that they were previously. A lot of companies are using AI as an excuse for that, and it's certainly going to be a real challenge for people in the legal and consultancy profession, because we've got such power now at our fingertips through Claude and ChatGPT and everything else. For sure, it's going to undermine the legal and consultancy professional, and people that are going to see that first are the inflows of kind of new graduates. So there's pushback from fresh graduates, definitely pushback from the public, probably wrongly pointed in my opinion, but as a result of the impact on energy prices.
Thanks for that insight. And that's definitely what drove the market correction last week, even though there was a suggestion that it was to do with other news flow. I think there was clearly a bit of a simmering up of that concern.
Yeah, most definitely. I think we're starting to see the first glimmers of concern in the market, and volatility is starting to rise with that.
I think that I've actually written down here volatility, because these things have volatility because they're such long duration, asset. You're not going to make money for years and years and years to justify a valuation like that. Whereas the volatility on tried and tested assets, we're going to come to it in a minute. The real assets is one. Volatility is really low in those areas. Some because they're privately valued every 6 months, 12 months. But the reality is that they do not go through these whipsaws. Property is the same. It doesn't go through a whipsaw. Occasionally, you have extreme cycles as a result of leverage, but typically you don't have that whipsaw. And that is an important aspect when you're trying to plan for portfolio construction and you're trying to plan for to match liabilities and so on. So quite an important aspect though when you talk about volatility and track records.
And I think let's move to nature finance now. So I think this came from your materials, and I think we've already discussed the aspects of nature finance, the inflation linkage, the compounding returns, a long life, as you mentioned, infrastructure like supply advantage, etc. I suppose I'd like to take the other side of that and ask, well, what's the pushback you get? What are the challenges you face? Is it around scale? Is it around is nature finance proven as a source of return? Where does it fit in a portfolio? Is it the infrastructure piece? And with the sustainability pushback, has this become less popular? So let's unpack some of the advantages.
Goodness, there's so much there. I think when I'm traveling the world, different allocators, it's not obvious where everybody puts this. They put different. Some put it in real estate. They have a bucket. Some have it in infrastructure, not a lot, but some also have it in property. So that is the biggest challenge, because when you go into an allocator, they go, so what is this? And they need to put you in a bucket. You're either equities or you're private equity, and that if you don't fit that bucket, all of a sudden it's too hard. And too hard means I've got to go back to the day job and do something else. I can't give you to somebody else to analyze. That is the critical thing. And what I always come back to is, if you go back 25 years to allocation, I think you was probably on some ICs then, just born, but I know you were just then. And there was no private equity allocation, right? In the average Lancashire, we managed private equity in the late 90s where I was, and they were one of the outliers. They were one of the first to do private equity. But most people had zero allocation to private equity in the year 2000. What happened then was a huge amount of education around the benefits of private equity, the outperformance of private equity, and what you then saw was an allocation that's grown over the last 25 years to 10, 15, 20%, depending on where you are. I believe we're at that stage because people are beginning to be educated on forestry, on agriculture, and biodiversity, recognizing they do have track records. So biodiversity is less, but agricultural land doesn't, has a long record. Forestry's got 30, 40 years of track record, and you can see the portfolio characteristics from inflation linkage through to volatility through to absolute returns. The UK, we've got 30-year track, 25-year track records at 10.5% per annum for that period of time, with a volatility which will beat all of it, everything, basically, any other asset class that you've got as a mainstream. The relevance of this is that as people get educated, they then say, actually, we do need something in that block. Infrastructure didn't exist 10 years ago. It now exists as an allocation of 3 to 7% typically. We are there again in nature, and we're seeing it with some of the local government pension schemes in the UK. We're seeing it in the Aussie supers. They're beginning to allocate. We've got evidence of them allocating between 3 and 5%, some of these guys, which is fantastic. Canada's been doing it for years. So this is really, really important because it does have when you look at the data, it enhances portfolios. The risk return that it goes in when you put it into portfolios is very, very significant. And when people who've got along 10, 20, 30-year time horizons, that is material on a compounding basis. So it's incumbent on us, Joe, myself, others, to educate, have patience, and then show that this is very similar to where private equity was 25 years ago or infrastructure 10 years ago.
And I suppose one of the questions, this next slide came from a World Forum thing. This is around just, and this is very small font, apologize, you can see it later in the slides, but just around where this sits in terms of its impact and its scalability. Because I think scale is an issue too, when we think about things like, biodiversity, say, or water. Is there sufficient scale that this can actually be an institutional level asset class, given that in the UK, the trend is for the pools to get even ever larger? So in terms of scale, and then in terms of the underlying sorts of returns, you mentioned carbon credits. Has that market sufficiently scaled to be of institutional quality?
So the answer is today, no. There is still a lot of gaps. So you've got well over 200 billion of AUM you can do today, but that is growing. And the important bit is the fact that you need, take forestry, for example, 50 to 60% of timber goes into housing. Housing, we know the supply and demand dynamics and the gap in that. And that's really important. Therefore, you need more timber in order to hit the housing targets, which are government related as well as policy related. So you've got a huge amount of structural growth things that are going on in this market, and it's growing. There's more planting. Yes, there's planning permission that's constraining, but it is happening. So that market is structurally growing, and it has got a long way to go before you, even if you have 1%, 2%, or 3% allocations in the Western world for some of the government pension schemes across already else, or even DC. I mean, DC's got an average of 0 allocation. So you've got quite an important opportunity. Still, there's a gap now where there is some supply opportunities, but over time it is a growing area. So I'm pretty convinced. But coming back to your carbon credits, that is a tough one. It hasn't got the longer. It's very volatile in terms of carbon pricing. There's only 2 markets in the world that are regulated: New Zealand and California. A lot of people don't see the track record there long enough in order to make it as investors. So when we put it in part of our forestry portfolios, we do not build in anything material at all in terms of our carbon expectation for value. However, you do recognize that it could be significant in the long term.
And we talked about momentum and zeitgeist and the fact that, clearly AI is where the attention is, and maybe the political winds are not necessarily in favor of the carbon credit market maturing, at least in certain regions. Has that set back some of this maturation at all? Political headwinds?
So that, or I mean,
I think the has been greatly exaggerated, to be honest with you. And one thing that we're definitely facing here all the time on the show, that we're going to have a kind of a super El Nino event. So people have kind of forgotten a little bit about climate change, because although global temperatures have been rising consistently, there hasn't been huge impactful events. So all of the indications are that those impactful events will happen in the next 24 months or so. I mean, the last El Nino event cost trillions of euros of infrastructural damage around the world. So that, is going to recur. There's kind of very little debate around that. So I think ESG hasn't gone away, and I think we're going to see an acceleration of all environmental system services markets. So we see it around water quality, flood relief, carbon, soil quality, biodiversity, air quality. All of these credit markets are definitely going to mature. And to your point about scaling, I think where we see it is that all of these service revenues will be stacked on top of traditional revenue, like agricultural output, like forestry output. So in addition to food products, timber products, that land-based activity will be modified to also capture ecosystem services as another revenue stream. So I think it will scale over the next couple of years.
And the reason I asked the question, I think it's important because I think I know a little bit about investor psychology and how investment committees work and how allocators allocate. And they do need to see their peers marching in step. And I think they cannot get to that level of comfort, despite what's going on the AI side, which maybe has no precedent, on, say, an area like nature, without seeing that there is scale, that they can grow into it, that it can absorb the amount they want to allocate. And there is a bit of necessary for education, as you mentioned, across the board.
So let me say that I agree. And there's no question as investors begin to realize where the capital is going into this. We are picking up tickets from Japan now. We didn't 3 years ago. It's coming into the UK. It's coming with us into Ireland. It's coming into North America. We're picking up tickets from the UK into biodiversity and into forestry, and the educate can see visibility now on given where they are in processes, and that there are allocations, and there'll be more out of the 6 pools that are left in the UK. We've already got 1 or 2 that are allocating to this area. Canada's been allocating to it a lot over the last 10 years, and actually because of their stresses and strains with their North American neighbour, they're actually moving their focus into Europe, and they're explicit about that. So we're seeing that in energy transition, and we're definitely seeing that in biodiversity stroke forestry. So when you start seeing these pools of capital, one of the biggest actually super funds one of the funds, Aussie Supers, has started to invest in global forestry with us as well. Again, these are really, to your point, people will start seeing their colleagues or competitors doing this, and there will be the momentum is building.
Yeah. Well, I just want to bring this to a close in a minute. I know there's some people in the room who can speak, but if there's any questions that they want to ask, I'd be happy to take any questions or field from Derek or Tony. Any questions? I have, of course, one as the host. I have one in reserve.
We haven't mentioned in Ireland specific, perhaps.
I don't think so. Like, we're obviously pioneering the creation of some ecosystem services markets here on a pilot basis, leveraging off our knowledge of the biodiversity net gain scheme in the UK. Gresham House is a leading position in that as a backer of the Environment Bank. So we're trying to take that knowledge and bring it into an Irish context, working with a number of government agencies to kind of try and bring that to fruition. And I think you will see the farming body quite supportive of that, because it's bringing a revenue stream to farm families that is not linked to productivity. Too many farmers here have chased, wafer thin marginal gains around intensifying agriculture. That's not sustainable financially, let alone environmentally. But when you start to allow them to de-intensify their agricultural production, replace some of that revenue by getting paid for ecosystem services, all of a sudden you have something that's far more sustainable for rural Ireland. So we look forward to continuing to play a leading.
It's quite exciting, as Joe says, what's going on in the world. Recognition you can make financial returns out of nature-based investments, forestry, land, agriculture. I mean, it's second nature to the Irish when it comes to land-based stuff. So it really is quite important to educate.
I did last question on water, and when Goldman Sachs puts out a report on water, I think then you probably have reached a kind of a mainstream. There's a lot of disease. We have some phenomenal storms here, and flooding and flood mitigation is clearly one area, or investing in water itself. Any insight into that as an asset class, or where we are?
We do invest in it as a team in our thematic fund. Water, select companies in the US predominantly is where we're finding them. But yeah, the water infrastructure globally is in an absolutely terrible state. So we are quite bullish about that spend. We think we said the next 20 years is about the real economy. The last 20 years was about the financial economy. The next 20 years about real economy. We need to fix the infrastructure. We need to start spending money, and we need to start doing it efficiently. Kind of always give the example: if you go to an airport in China or an airport in Atlanta, you tell me which is the emerging market and which is the developed market. And we think the developed markets need to actually start spending and bringing their capital stock up to the levels we're seeing in the emerging markets.
Well, it's good that Goldman's are doing this, because if you look at it goes straight to land. When you talk to people about investing in farmland in North America, they talk about the availability of water, particularly in California, and the inability to do olives and pistachios and so on as a result of the lack of water. And that's the same in the Andalusian and in Iberia. So it is material and is constraining things. I know that there are allocators in Germany, for example, who have built climate models that are saying, actually, because of climate change, we need to start investing in Northern Europe, the UK, Scotland, to access timber, because their climate models say that that's going to be the best area in order to pick up returns. So it is really material.
So some opportunity in the blue economy. Just a question of, again, scale and putting some kind of numbers on it and thinking about risk return characteristics, exactly, and putting it on that.
Interested in terms of the ability of kind of eventually maybe retail investors being able to get access to this space at some capacity, because I think it resonates, as you say, with particularly in Ireland. There's a kind of let's say some experience, and it's tangible, right? It's possibly more tangible than private equity funds, where it's a bunch of different companies. You don't have any maybe real sense of it. So I'm just curious to see where what your sense is maybe over the next 5, 10, 15 years, kind of what the journey might be there, if there will be a journey in that kind of direction.
So the key area is retail access is wealth channels. And the wealth channels, DC, if it's pension or directly with a wealth manager, you have to be really careful, because the education aspect I mentioned is it often isn't one that the retail picks up, and they like the let's stag this SpaceX and get out of it tomorrow and we make some money type of mentality. I was on CNBC only last week talking exactly about this. If you look at Partners Group last week, they have an open-ended fund that's being gated as a result of, because their wealth channel is getting whatever it is, short-termism, let's call it, for whatever reason. We've seen this in the past. Property in the GFC was another example. So key point is the retail channel and wealth channels are going to grow materially more faster than obviously the DB stroke, the historic channels of long-term investment endowments and so on. So that's material. Therefore, one has to be really careful about education in order today to match those asset investments with the duration of people's investment horizons. Because if the retailers always, majority are always going to have some sort of short-termism about them. And you have to be really, really careful, and you'll miss out the dislocations that happen like they do now is where you make the most money, right? Where you if you're not involved and you go into areas where people have got to sell and they're forced sellers, that's when you should be getting involved. So to the point, education and being very wary of short-termism.
And I can answer a little bit on that, given I'm in the wealth channel. And I'd say what I could see is this has to be pull, not push, i.e. we cannot push this on clients. It has to come from them organically, because then we then know that they are committed and have conviction in there. Again, education is key. I think the private credit debacle with these redemptions and private credit, many of these investors had no place investing in private credit if they were trying to use it as a source of liquidity. So again, we need to, I think, educate the advisors as much as educating the underlying. We all need more engagement with our money, with our pensions, with our finances. And I think that part, because it does resonate, it is visceral, the connection with the environment, with what's growing. And I think it's going to be a long journey, but I think if you get the right advisors on board, that journey can happen. And again, realizing this is the ultimate long-term investment. I mean, there can be a return, right? There can be a yield, but it should not be seen as anywhere close to liquid.
Definitely.
Just on that topic, it's the Minister of Finance announced yesterday evening or this morning a suite of financial literacy measures. This is in advance of the introduction of a savings and investment account here, which is to try and get more retailers taking money off non-interest bearing deposits and put it to work. So, although real assets isn't a focus of that, it is the beginning of educating the wider retail market about considerations around investing.
Here, I couldn't think of a better place to bring this to a close. I think on that very positive note, which is something that I think we'll all support. Well, thank you very much to everyone for coming and for listening. Thank you to Tony and to Derek, to Joe for hosting us here, and for everyone to listening to the Markets Happy Hour podcast.
Well done.